Well, we're about to start the second quarter of 2023. I'm going to tell you, here in Phoenix, Arizona, the real estate market has popped up a little bit. We've gotten a little better sales. The fourth quarter of 2022 was kind of a tough quarter. A lot of fear in the market, but we are doing better today. But is this the end of the correction? Because, we've been forecasting a fairly significant correction in an ongoing bull market. Now, here in Florida, Texas, and Arizona, in particular Arizona, we just have an enormous bull market here. We're looking at a decades-long bull market, but they don't go straight up. And this correction is going to give us an opportunity to get a much better buying entry. Now, if you've been following our work, you know that we've been out of the market since March of 2022 with new capital. Now, we're still changing portfolios around and doing IRC 1031 exchanges. So we're moving properties, a lot of them from the West Coast to Phoenix, and getting some very, very good properties that we think will have very, very good long-term prospects for them. But I think it's too early yet to get into the marketplace. Let's go my very first slide. Let's just talk about it, and welcome to your comments. By the way, we try and bring really good content. I take this very, very seriously. If you like the videos, you could really help me out by giving me a thumbs up and subscribing. I'm going to tell you, we're not going to sell your name to anybody. We're just trying to get 1,000 subscribers because YouTube likes 1,000. That's kind of like a magic number for them. So let me go to my very first slide. Let's just talk about what we see. Now, here's what Lawrence Yun has said. Now, he's the chief economist for the National Association of Realtors. He said, after nearly a year, the housing sector's contraction is coming to an end. Well, we'd certainly like to think that that's the case. Our forecast is not that. We expect to see further declines, and I think that there won't be a buying entry point until probably third quarter, maybe fourth quarter of this year. So that's a long time to be accumulating cash, but that's what we're doing. Now, if you look at this slide, now this is a fairly recent slide. You can see that there was a nice little pop coming up here into the end of the first quarter of 2023. We expected that. We've been forecasting that we would have interest rates giving us a little bit of retracement into the first quarter, and that's what we've seen. So we've seen interest rates come down, and of course, as interest rates come down, we've seen home sales come up. That's right in line with our forecast, because as you know, as rates rise, home prices die. And you can see that the rates are inverse, and the higher the rates go, the lower that sales goes. And you can just see again here, this is mimicking the last one. We've got a little bit of a pop as rates came down, prices came up. So this was really, really good for us, right in line with forecasts. We thought this was going to happen. We've been fully anticipating this. We're watching what's going on. We have seen some retracement in prices in all across the country, actually. Certainly here in Phoenix, Arizona. Now, the reason for the problems that we're having is liquidity. Liquidity has been in the news this entire time. So we've been talking about the fact that a lot of the banks just don't have any cash. That's what happened with Silicon Valley Bank. That's what happened with Credit Suisse. They ran out of cash. Now, there's been in the news that the Federal Reserve has added $300 billion in liquidity to the marketplace, and everybody's kind of jumping up and down. I'm going to tell you that's not going to go into the economy. That went to the banks. The Swiss National Bank backstopped the Swiss credit sale to UBS with $100 billion. But where did they get that $100 billion? They got it from the Federal Reserve. So that's where a lot of the money went to, is into the banking around the country. And you're not going to see this go into the economy. Now, if they continue doing this, it's going to help. But I don't believe that's going to. This is just kind of like a one-off, because there is a concerted effort to remove liquidity all across the globe. You can see it on all our charts. This is what caused the pop. You're going to see this bubble virtually in every chart we have. It doesn't matter what asset class it is. We have this bubble that came up. Now, this turquoise line, that's the U.S. nominal GDP. And of course, obviously, when you have this liquidity pop, you're going to get a GDP pop as well. And it's a lagging indicator. You can see that this lagged the pop in the liquidity. And as liquidity is coming down, we're seeing that the GDP is following that down course with a lag. So we don't think that lag is done yet. We don't really see this happening for another probably 6 to 9 months pretty easily, because there's no liquidity. And of course, this is a historical lack of liquidity. Never, ever happened before. We all know how long ever is. It's a really, really long time. Now, when you have a lack of liquidity, you don't have much cash to lend. So you're very, very particular as to what cash you're going to put out, who's going to get it. So that's where you see underwriting start to tighten up. The tighter the underwriting, the less and less projects there are around the country and around the globe to be done. That's certainly going to affect employment, supply chains. People are going to unemployment's going to rise, and we haven't seen the end of it. It is a lagging indicator, and it's coming. Now, just look at this. As rates go up, we have experienced 7 months of home price decline across the country. This is coming out of the Case-Shiller index, and you get that from the Federal Reserve Electronic Data System. You can see that they have wonderful, wonderful data, but this is coming from the Case-Shiller. Now, it's also a lagging indicator, so this would be in January, so it's not picked up the first quarter pop that we forecast. So it's very, very possible that this decline slows down or actually even goes into the green. That would be really, really good. However, I think that we're just looking at a bounce in a continuing contraction. Now, this is a wonderful chart that we've received from Zero Hedge, and it talks about some of the locations in the country. Now, San Francisco is leading the pack with declines of 17%. Now, I've seen declines depending on whether you're talking about just the city of San Francisco, the area, or the entire 5-county area around the San Francisco Bay Area, depending on how far it's gone down. I've heard that San Francisco is down up to 30, 35%. This is saying it's 17%. Whatever it is, it's awful. So if you bought a $2 million house at the peak and it's declined just 17%, you have lost $340,000. That's not a good thing. Probably most of your down payment has been wiped out. Now, here in Phoenix, from the very peak, we're down 10%. Very, very good properties now. Some very, very good pricing. I anticipate those prices are going to get even better, and we're going to have an entry point for us to put capital out. That means if you're a first-time home buyer, if you just wait just a little bit, I think you're going to do very, very good. Now, if you're selling a house in New York and you're moving to Phoenix, well, you sold in the market, you've got capital that's seasoned in the market, you can bring that capital here and just buy again. It's not new capital. So you're just taking capital from one side and we're just transferring it. Very similar to what we do with the 1031 exchange. I think that's fully acceptable. That's no problem whatsoever. If you're selling in New York, getting into a better market of Florida, Texas, and Arizona, certainly deploy your capital. I think that's just a great idea, because owning a house is a very, very good idea for almost all families. Now, here's one of the reasons. Now, I'm going to talk to you about this. This is coming from Charles Hugh Smith. He did some wonderful research. He's done the calculations for bubble symmetry. He's talking about retracement. Now, this is coming off the .com. He's using it as an illustration. Let's go to a current. Here's the S&P 500 bubble symmetry. He thinks we have a brutal retracement back to about 45%. That's on our forecast as well. We think equities could easily go down 45%. He thinks could go down 55%. Very likely. So again, when you get this type of forecast, always pays for you to talk to your financial advisor, see what your exposure is. You don't have to be 100% invested at all times. You know, you can follow Dr. Nunner's work. He and I do a lot of videos together. You can get an idea. You can also, he gives a 30-day free trial. A lot of these advisors do that. This would be a great time through volatility to start getting some advice. Certainly talk to your financial advisor, find out what kind of exposure you have. And here we are with the housing industry. Now, Charles Hugh Smith thinks that we could easily get a 30% retracement on a bubble symmetry. Yes, and we've talked about our charts. Right here was the explosive phase and the accumulation phase. You know, we fully expected it to expand like this. We thought it would go even higher. Could we get a 30% retracement? Yes. We think we're going to get a 35% retracement. Now, that doesn't necessarily mean Florida, Texas, and Arizona are going to retrace the same as everywhere else because there's so much in-migration and housing shortage in these fabulous marketplaces. Now, we're hearing that 2 years ago, we had a 4 to 4.5 million house shortage, unit shortage for housing across the United States. It's gotten worse. So we now have immigration that's added 1 million to 2 million households, and the builders are chasing a boulder rolling downhill. They cannot get enough. So now I'm hearing charts are telling us 6 to 6.5 million housing units short across the United States. Some areas are going to have much more shortage than others. Florida, Texas, and Arizona are the obvious candidates for that. So when you have shortages, now here in Arizona, I'm going to tell you, I know that we're short. Our housing stock is fairly tight and rentals are very, very good. So it's very, very good for existing investors. We're doing very well with our cash flows, but we think we're going to get an even better buying opportunity and an entry point. So I think we have at least a 30, maybe a 35%. Could get even better here in Phoenix, Arizona. Charles Hugh Smith thinks it could go to 60. That would be a pretty drastic retracement. I don't think we're going to get quite that much, but I do think we're going to get 30 to 35%. So please contact us. We're more than happy to talk to you. We're more than happy to consult with you, with your spouse and your financial advisor, and see if we can't see if this is going to work for you. We've been talking about the fact that if you just had just two properties in your portfolio, it's going to make a huge difference in the cash flow that you receive when you retire. You know, and if you have a property here in Phoenix, Arizona, you buy one for about $400,000, your first $12,000 to $15,000 of income, tax-free because we get depreciation. It's a very, very good deal. So if you talk to us, we're more than happy to sit down and find out what's good for you and if this is going to work. Now, we're here at West USA. They do our compliance. They do our back office work. This is their corporate phone number. You're welcome to reach them. Just ask for Michael Douville. We're more than happy to work with you. We love your business. And if we can help in any way, please give us a call. My very, very best to you. Bye-bye now.